You're watching Your World at 10. The raging debate on interest rates is back.
We feel that there is still scope interest rates to little bit soften. This is what governor is indicating again and again.
Gradually, I would see that the interest rates could harden. When would depend on how the credit offtake picks up. But my feeling is that from here, the credit offtake will only pick up.
I don't see any possibility of interest rates rising till about Diwali, till the busy season comes, October, November. Whether between now and then, it may go down by 25 basis points, 50 basis points in the case of some banks or financial institutions. There is a possibility.
My personal view is that the Indian central bank may actually move ahead of the curve vis-a-vis the global banks. I think we will see some move in the quarter October to December. It may not be a big move, but clearly some signaling move which may happen from the central bank, and we should be ready for it.
Is market pricing too much aggression from RBI? We believe in the short term probably that's the trend. The 10-year yield could decline a little bit from current level as the pace of borrowing program slows down.
All right, so there you have it. The Deputy Governor of the RBI, Chanda Kochhar of one of the country's largest lenders, ICICI, O.P. Bhatt of the country's largest lender, Uday Kotak, a well-known banker, and then you've got Nilesh Shah, all of them with differing views on interest rates and where they're headed in the next 3 months. So are rates headed up or down? Joining us tonight with their views are Dr. Haseeb Drabu, Chairman of J&K Bank, and Jahangir Aziz, Chief Economist at JP Morgan India. Well, let me start with you, Jahangir. I'm told you believe that rates will not move up in the next 3 months. Why is that?
Largely because I think, as Nilesh pointed out, I think the market overreacted to the governor's statement. I think the governor's statement should be taken literally rather than trying to read out meaning into it. I think he said that, India will move ahead of other countries. My guess is that other countries meant US. Nobody is really thinking about a US move before the second half of next year. My guess is that the market overreacted, and I think that once the second half borrowing program is announced this September and the RBI holds in the October policy meeting, the rates will come down. But I think that the threat of tightening is going to keep rates from falling appreciably. So you might see some softening, but not too much. It's probably going to wobble around a bit till probably January, when the RBI will probably make its first move.
Haseeb Drabu, do you agree with that?
Not really. I mean, I would tend to look at the other way. In terms of, when you look at it, forget the macroeconomics of it for a moment. When you look at the operative realities in the market, Q3 will see a hardening in the rates. This has been my consistent position after the announcement of the government borrowing program, but it may get towards the month of, let's say, November, December, because the credit offtake hasn't really been what it was expected to be at the beginning of the year. The slowdown has persisted. So we may see that it may get delayed, but there is no denying the fact that one is expecting a hardening of the rates. Now, what is it that you're really talking of here? Are you looking at market rates of interest, or are you looking at policy rates in terms of Reserve Bank of India? I would be inclined to believe that Reserve Bank of India may not raise the rates, because I think that would be counterproductive in a situation where we are today, where the recession having been prolonged to beyond Q3 now, we don't see any major demand. When you're looking at the banking sector, the credit offtake is still very, very slow, and it's coming from sectors and not the ones that tend to absorb most of the credit. So I would tend to go in a sense and say that the RBI may not raise policy rates, but the market rates in the debt market and others in the banking segment would actually see a hike in the course of Q3 or in the beginning of Q4, but we have definitely seen a bottoming out of rates. And this will also coincide with the busy season, plus also the pickup in demand, plus the absorption of liquidity, which at the moment is the markets are awash with liquidity.
Why do you think, Mr.
So my own sense is that markets
Dr. Drabu, why do you think rates will move up, considering that from what I understand, the corporate loan book has only been contracting month on month or remains unchanged, so we're not seeing that much demand come in from the corporate end. And in fact, I'm told that banks as of now parking over 1 lakh crore rupees overnight with the RBI to indicate that there's that much excess liquidity to be able to mop up any increase in demand if it happens in the busy season over the next 3 months. So why do you believe that market rates will go up even if the RBI doesn't signal higher rates?
Largely because the absorption of liquidity by the government, it will preempt a lot of liquidity. I mean, there is a enormous amount of borrowing program that has been announced in this budget, and that is also not reflective of the actual extent of borrowing. If you look at the total program in terms of what it requires, I would tend to see that liquidity, the current level of liquidity will not sustain, and that would be the reason for revving up rates. And we do expect a pickup in demand somewhere towards the end of Q3 or Q4. And Q3 tends to be the busy season, so it will be a mix of both these factors. It will not be a demand-driven kind of rate hike, but the fact that liquidity will come under some pressure in the course of the next 3 to 4 months.
Jahangir, how would you respond to that? Because many people believe that the government's borrowing program is very front-loaded. They haven't made any announcement on whether they intend to borrow more than what was previously stated on account of the drought, or any such further enhanced spending programs. So do you agree that it's likely that post the government announcing its further borrowing plans, rates would likely go up, as Dr. Drabu indicates?
Not really, because I think there's a lot of skepticism that the government's second half borrowing program will be probably as large as the first half, because that's what the government has done in the last 2 or 3 budgets. I don't think this will happen this time because there was a deliberate attempt to front load it. So even if you add the state loans that will come due in the second half of the year, add a little bit of oil bonds or fertilizer bonds to it, you really require a massive increase in credit growth. I mean, right now, on an annualized basis, September over March, credit growth is about 3% on an annualized basis. You require something like about a 40% annualized growth in credit in the second half of the year just to bring the excess liquidity of 1.5 trillion that you were talking about down to its normal level of 350 billion. So I think when people are talking about credit offtake picking up, they really need to look at the order of magnitude. We are talking about a swing from a 3% annualized rate in the first half to about a 40%. I mean, that seems a bit too high for me. And do not forget that in almost all recessions, in the beginnings of the recovery, you don't really require much credit growth to finance that recovery. Because corporates have a lot of cash, they have alternative means of raising funds in equity markets and corporate bond markets. So typically what you see in the first 2-3 quarters of a recovery is that private sector credit growth or bank credit growth isn't very much different from the last 3 quarters of the downturn. So I don't really think that the credit offtake that people are expecting is going to happen in anywhere close to what is needed to sort of put pressures on rates.
Jahangir, what about the other big I word, inflation? Now, I know that the headline number has only just turned positive, but food price inflation has been going up fast and going up fast for many, many months now. Now, many people say that's a supply side problem and it cannot possibly be fixed, or best be fixed by a hike in interest rates. But do you think what we've seen happen to inflation in the past few weeks, especially today, is likely to make the central bank more hawkish or less dovish on rates in a fashion?
I think there will be, in the sense that it is a supply side phenomenon, and nothing that the RBI can do will raise agricultural output this season around. However, if this increase in inflation actually starts get embedded in inflationary expectations, so if people start believing that this inflation is going to persist and they start bringing forward their purchases, and therefore you see a spike in credit growth, a very sharp spike in credit growth that is not corroborated, let's say, by an increase in real activity, I think then the RBI will be concerned, because that would signal that inflationary expectations are taking root. But nothing of that sort is happening. I think the other inflation that people are not focusing on is asset price inflation. I think, given the talk about financial stability that the governor has been doing in recent days, I think financial stability in India, in Indian central banking framework, financial stability also in Korean banking framework, in People's Bank of China's framework, in all these banks, financial stability has become an important objective. And I think if they do see, let's say, bank credit seeping out in some form or the other, and fueling a real estate price boom or equity price boom, again, none of that is happening. But if you do see that happening, I think the RBI will start cracking down. But in that case, I think they will use prudential means rather than rates as its first line of defense.
All right, so Mr. Drabu, I think Jahangir's flagged off the inflation flag, so to speak, but says none of it is happening as yet. Would you agree with him, or do you think that the RBI will move in even if the signs are early?
No, I'm completely in agreement with Jahangir on the issue of inflation, but I'd like to go back and look at the whole issue of credit growth because, as you pointed out, that it requires 40. But the point really is not so much of fresh credit accruals. Today, the banking sector is sitting on about 50,000 crores of unavailed limits. Now, the moment there is even a hint of a recovery, all this gets utilized. These are not fresh sanctions, so to say. These are unavailed limits. So to that extent, when you look at that growth, then any amount, a slight signaling of even the busy season onset actually will see a very, very high increase in credit growth. Not to the extent of 40% as he says, and 40% may look a large number, but when you look at why the current levels are 3%, it's not because of fresh contraction of debt liabilities, but largely because of unavailed limits, and those are in existing business. So to that extent, the growth of credit would ramp up quite rapidly in Q3, and that coincides with the busy season. So that probably would force the market rates up, as I was saying. As long as inflation is concerned, I completely agree with it. I don't see that RBI would, at this point of time, use the rate side to look at that, but would probably focus more on the prudential side to kind of tamper that down. And the problem that will also emerge towards the end of Q3, Q4 is the whole restructured loan book of which the Reserve Bank had allowed banks to do will actually start coming back to the system, and that itself can be a big factor for credit growth, as well as some problems may emerge from there.
All right, so quick, I have only a few seconds left on this discussion. Dr. Drabu, very quickly, how much do you expect market rates to go up by in the next 3 months, or let's say by the end of this year?
25 to 50 basis points.
All right, so Jahangir, when's the earliest you expect rates to go up, and by how much?
I think rates should go up by somewhere in the beginning of the year, and it would probably be because of some form of tightening by the RBI itself.
As what, 25 to 50 basis points, or you expect sharper tightening?
Probably around 25 basis points. I wouldn't go to 50 basis points as yet.
All right, gentlemen, thank you very much for joining us on this debate. Hasib Drabu, Jahangir Aziz, thank you very much for being on Your World at 10. With that, we need to take a quick break. We'll come back with all the national and political news headlines.